Welcome, George. Good to have you on the show. What sort of figure would you put on tax avoidance by multinational corporations globally?
Michael, I'd estimate about $1 trillion a year.
And Australia?
About 50 billion. But I'm conservative on both points. I think the figure could be much higher internationally, being several $1 trillion a year, because most of it's undisclosed. There's no requirement to disclose. And Australia, for the same reasons, the disclosure requirements are so weak that we can't really get an accurate number. $50 billion is the minimum amount I would suggest.
So you advocate that the big four global accounting firms, PwC, KPMG, Ernst & Young and Deloitte, should be broken up. Why is that?
That's correct. Simply the cost of the community is so great that the people who are really affected in society are the least privileged. They're people who are homeless, they're people who are the subject of foreign aid programs, the women who are beaten in shelters. Now, all these programs have been slashed in recent years, and we have to focus on these people. They don't have a voice in society, but really at the end of the day, everybody pays for it. Even Middle Australia pays for it.
So you're saying that the big four are the engineers of the tax avoidance schemes for the multinationals?
Correct. The multinationals don't build these schemes within themselves because they don't have the capacity to verify the structures or at least put this sort of argument forward. And the sort of money that's required to put it forward is expensive, and the sort of knowledge is in the big four accounting firms. They're trying to dress up what would otherwise be perceived as legitimate transactions, right? And in reality are either outright tax shams or on the border of outright tax scams.
Well, obviously it's a problem. So what's your solution to this scourge of multinational tax avoidance? Walk us through your 5 steps.
The 5 steps are, firstly, to separate tax and accounting. Now, it's very difficult for an audit partner to operate with a lot of pressure from the tax partner, saying, well, we've got these tax structures in place, we've got to make them work for the client, otherwise the firm is going to look bad. So the accounting partner is under tremendous pressure to actually fall into line with the tax guy. Equally, the accounting partner actually has a lot of knowledge, and the trouble is with this, that in having all this knowledge of appropriate structures, these structures can be seen to be look kosher, but in reality are not. There's a well-worn path in every accounting firm between the tax and the accounting partner's office to discuss these matters in relation to the client. The auditor's role is to verify the accounts. It is not to get involved and assist in tax scams.
Right, so what are the other things that can be done?
Well, basically, if we split tax and accounting, we'll have essentially four audit firms and 4 tax firms. That's not enough for competition internationally. We should split each of these firms, so there's 8 accounting and 8 tax firms. And then you've got a proper competition in the market, and equally, there's a concept of simply being too big to fail. If you've got 8 firms, 8 accounting firms and 8 tax firms, you can take appropriate regulatory action to knock out a firm if they've done the wrong thing, or at least regulate things properly. Smaller firms are much easier to regulate. The third step is to introduce what I just call an ethical tax regime, but it is in reality a no-risk tax regime, whereby if they follow a certain process, they will have a no-risk tax outcome, a certain tax outcome in other words, and to reward them by discounting the tax rate. It could be 5%, could be 7%, it could be 3%. But it's important that this reward be much more beneficial than the product of aggressive tax practices, which is the other side of the equation. The penalties currently are too weak. There's never been a CEO put into jail for tax avoidance. Now just imagine if Steve Jobs, instead of dying as a great Apple hero, he was actually in jail for Apple's aggressive tax schemes. What message would have that delivered to the community? I think would have been an extremely powerful message. The directors have a duty anyway, and if the law doesn't state that, they certainly should have a duty. These guys steer the company. If something is done that's incorrect, it is they who should pay the penalties, along with the senior executives who proposed it. But a director's got to have sufficient filters in his arsenal to say, well, this is acceptable and this is not, and be in a position to ask the relevant questions. He must also set or she must also set a mandate to the advisors, saying we have a no risk tax position. In other words, we want certainty. as a director. And if you as advisor, if you misadvise us, we're in a position to actually sue you for damages for the loss that we've suffered and damage to reputation.
And the final point?
The final and fifth point is simply this, that we deny all tax deductions in transactions which are associated with a tax haven. So if there's a loan arrangement, if it's a service arrangement, or if there's intellectual property owned in a tax haven or placed in a tax haven, we deny tax deductions in the home jurisdiction. Now, we have 5 building blocks. Okay, it's important that each country introduce the same 5 building blocks, so there's international cooperation to prevent the scourge of international tax avoidance. And so the peddlers of greed really can't use this financial saw which we've got for their own purposes and own gain.
Thank you, George.
Oh, you're welcome, Michael. It's a great pleasure to always talk to you.